What's up, everyone? Welcome back to another episode of the podcast. It's been a while since we've been in person, in the flesh. This is the first in real life podcast back. I'm so excited to be back, and I'm back joined by my good friend, Beau Arfi. Thanks for coming on, man.
No, my pleasure. Thanks for having me, bro.
Anytime, bro. So Beau is 27 years old, owns 17 properties, and we're going to find out how. Like, whenever I tell anyone that, they're like, wait, hold on a second. How does that work? Was he given like a $10 million inheritance? Did he find a way to extort the system? And that's just not the case. He's just very smart when it comes to the property game. So smart that after, accumulating some property and really gaining a lot of insight into the world of property investing, he started his own property investing investment firm, which specializes in actually helping everyday Australians grow their property portfolio, called Maple Property Group. And yeah, go check out their website, and hopefully you like the design because we did it, and I'm sure you'll love it. But I'm really keen to have you on, man. It's a nice, I guess, episode to come back on. Congratulations, you just also bought your own office as well.
Yeah, thank you.
So tell me about that, man. Like I really want to hear about like the story, but one thing I asked you before we jumped on was why buy an office and not actually rent. So I'm curious to know that first, more selfishly, and then we can go from there.
No, completely. I suppose for myself, I invest in primarily I invested in residential property, and then more recently I begun to invest in industrial under the commercial sector a little bit, and also I preferred to own the dwellings of which I reside. So I don't know, call me old school. If you look at the numbers, it's going to be much better to rent and invest. It's probably not going to be more beneficial for me to actually own these dwellings. I could put more money elsewhere and further invest. But for me, I feel like I've got a good base benchmark of what I want, and I just like the idea of it, man. There is no statistical benefit for me owning the dwellings.
It's more just because I want to, right?
Completely right.
It's like a preferential thing. So I guess you're at a point now where you're like, you know what, I've got my investment sorted, and I want to own the office that I'm in. It's not like it's an actual correct investment thing or the better investment option, but it's just what you want, which is, I guess, a place that a lot of us want to get. So let's talk about how you even got yourself to this position. So I'd love to know really early on, like how, it's like you started, I think you got your first property at 18, right?
Yeah, it was 19, yeah.
19.
Yeah.
So in 8 years, you grew that portfolio to where you are now. Yep. How did it begin? Give us the early journey and try to give these amazing viewers as much detail as possible.
No, completely. Well, I guess the first initial inkling of when it started, I was never somebody that wanted money or or freedom, or it wasn't anything that I was remotely interested in come 18. And it kind of started as a small seed quite early. After attending a seminar, actually, I was invited to, and more so forced along. And
what seminar was it?
It was a Arnold Schwarzenegger, Pat Mesiti, just some general self-development seminar that I kind of got pushed along to. I didn't even really want to go. I was like, what is this,
Yeah.
And I got pushed along to go, and I was like, yeah, all right, I'll go. And at the time I was a dishwasher. I worked at a restaurant, and I didn't really have too much and wasn't thinking about investing. This would have been, probably 18 and a half or something. I just finished school. I'd done very badly in my year 12 VCE exams. I think my ATAR was like 43 or something. and I fucking tried too.
Yeah.
Like I really gave it a red hot crack. I mucked around from year 7 to 11, but year 12 said I thought I'm going to hit it up and give it a good go. But it started after this seminar. It introduced me to a new way of thinking. And I thought I had a family friend who was doing significantly well in the property space, and I'd look at some adults and older people who were struggling and arguing about money, and I'd look at this person who was close with me my whole life, and these people were always on holidays and having a great time. And I more so went to this seminar, he took me along, and it just completely opened up a new way of thinking. And after this seminar, I was just like, I need a property, I need to invest. And there were some bad investments that I wanted to invest in. I wanted a student accommodation and all these things that were, in hindsight would be horrible, but I just wanted something, and that mindset just changed, and it was a switch. I read Robert Kiyosaki, Rich Dad Poor Dad, and I just became laser focused. I just wanted something. I didn't care if it was good. I just wanted something. And
you just wanted to jump in, right?
Yeah,
you know, it's funny.
it.
It's like I was thinking about Robert Kiyosaki, Rich Dad Poor Dad, because that guy is essentially that rich dad figure.
Yeah.
And you got to meet him.
100%.
I know. How crazy is that? And you like pretty much open your mind. Cool. So you started at a seminar, which is great, and an awesome point, I think, for people watching. Like, of course, you can get some really terrible seminars that are really just there as a cash grab, but don't hesitate to attend, you know, seminars that are free, or maybe have a small ticketing fee, and then soak in all the knowledge that you gain from there. And it's also the network that you can also develop. So you started there. Now, from working as a dishwasher to making a decision you want a property, what was the time frame before you got into your first one, and what did you actually buy first?
It was probably like an 8-month thing, maybe 8 to 10 month thing where I just had laser focus and I wanted to get something. I think at the time I probably only had $12,000 in the bank, but I just knew I wanted something. So at the time I was at university.
But at 19, that's pretty good. Like, I didn't have that at 19. So were you always really good with saving, or you were always pretty...
Well, actually, I did a commercial when I was like 8 or something, and I got like $4,000, and my parents put that into my account. So
a commercial?
I used to do like acting and stuff.
Like commercial. I'm like, I'm in the property headspace. So when you said commercial, I'm like, what commercial? I'm thinking commercial property right away. So you did an actual commercial.
I did an actual commercial.
Oh wow! And you made like $4,000.
Yeah.
Oh, that's cool.
And that $4,000 was like, that was about the only help I'd got from family.
Yeah.
That $4,000 was the start of a small deposit, and then at the same time, you know, I just worked in high school, and I was a dishwasher. I worked 5 days a week. After uni, I would work from basically 5:30 to 10:30 at night, pretty much 5 days a week.
And you were just saving most of the money that you were making.
I was just saving most of the money,
Wasn't a big spender. Wouldn't go out. Would you go out and eat a lot? Did you have like rules? Like, because I'm just thinking, like, you know, still, you know, like having saved that much at 19 is still quite impressive. Like, it's not a small amount. I think like there's statistics, like you would know the statistics of the average savings that someone under 25 has. It's a lot smaller than what you would expect. Completely. I think it's even less than 10 grand. Yeah. The statistics show. I'll fact check it somewhere in this video, but so what was like your philosophy money wise?
Well, I just like seeing my account go up. That was it. You know, whether it was $100 or $200, there was no goal behind saving. It was just I wanted to build it up, but not in the way of I want to build up and invest. It was just I like having a little bit more money in my account. I like it going up more than down. That was about it.
Yeah, very cool.
There was no strategy.
Very cool. Yeah, like the richest man in Babylon. One of the rules: make sure that there's more coming in than there is coming out, and you'll be fine.
100%.
Cool. So now you had 12 grand, and then 8 to 10 months later, you had gotten your first property. How much did you save? How did you make the decision to buy the property? Like, were you researching on the side? Like, what happened after that?
Yeah, 100%. For me, I was never somebody I did my research, and, you know, I was on realestate.com every night and looking, but I wasn't, you know, I think too many people get analysis paralysis where they're thinking, oh, you know, this property could have 15 things that are amazing about it, but then one thing that there's an issue, and then all of a sudden they play on that one thing. For me, it was more so, you know, I would do the research, absolutely, but I was more so encouraged and motivated to get a foothold in the market, and I was so optimistic about the market that I just wanted something. So I was probably ignoring a lot of those, you know, if there were red flags, I might have been ignoring a lot of those just because I wanted to get in. And it wasn't even to make $1 million from this property. I wanted to get in so I could learn the game, so I could understand how does it work? What are the outgoings with property? How hard is it to get a tenant? What are the risks? Like, I just wanted to learn so I could expand my knowledge. And part of the reason I guess I own the properties that I reside in, I mean, you know, commercial is also a great investment, but I invested in that so I could learn about it and then compare my residential investments to my commercial investments and actually have a physical asset that is a commercial industrial property. The other thing is I'm very optimistic about Melbourne. To answer your question before when you said, why do I own the properties that I'm in? I love Melbourne. I think that, the building that I'm in at the moment is, it's sort of wedged in the middle of St Kilda, South Yarra and the city. And it's like a 5 kilometre sort of tram ride, not even 5-minute tram ride from Flinders Street Station to 1 Queen's Road, which is considered Melbourne still. So and this new office that I've got is basically overlooks Albert Park Lake. You'll be able to see the F1 from there. And it's basically wall-to-ceiling views. And I just think it's an investment in that great city. There's a train station coming up. I think that in the future, Melbourne's got a lot of exciting things, and I just wanted to cement myself in this suburb. And frankly, I didn't see the rush to go from 17 to 25 properties.
Yeah.
And I was happy to just
Fair
start
enough.
and to me that's balling out. That's going, instead of buying a brand new car, I'm buying an office that I don't have to buy.
Yeah.
That's sort of my thinking.
Yeah. Because you recently as well bought the property that you live in.
Yeah, exactly.
which again, like, is interesting because there is the rent vesting mentality, which I know that you agree on as well. And again, is that just the same mentality? Like, you just wanted to, like, it's not necessarily because it's the better approach. It's just, I just wanted to.
100%. When I did so much of what was the best approach, what was the data's telling me to do, what was the statistics, I had my head down for so long in terms of what the right thing to do was, that once you build up a certain level of equity, you can afford to be a little bit silly within reason. So although this wasn't the best strategy necessarily, I just, and for me, my mindset long-term is, I want to have a base here. So I love Melbourne, but I want to have a base here of a property that I own, that's set, that I could go overseas for a few months and come back and the place is exactly as I left it. It's low maintenance, and that's sort of just where I'm at. And my mindset is, absolutely, what if I want to move elsewhere? Like, what if I want to live by the beach, or what if I want to, move into state? If I need to, I would sell it, and absolutely I would make a profit just based on where the market's gone. But ideally I hold on to it and, and trust that I've got a property in a good area. So it's probably just some ingrained thing in my mind that, for right or wrong, and the data and the stats say that it's better to rent vest, absolutely. But for whatever reason, I'm so engulfed in the accumulation and just owning things that, maybe to the detriment of what I'm doing, it's probably not the best way, but I'm happy.
But like you said, man, like, okay, what's the rush in going from 17 to 25? It's so we'll definitely circle back on this conversation and talk about it a little bit more, especially on the balling out part and that versus, say, buying cars and the more materialistic things. But I do want to kind of go back. The mentality that the viewer has, as how I'm imagining, is someone who's sitting down who's either got a property or has some savings or is thinking about wanting to have a property portfolio, and they're going, tell me the exact steps I need to take. And the best way to go about that is more just finding out about your journey. So now you've done research. Like you said, your focus wasn't to have analysis paralysis. You were researching. You were taking a look on realestate.com. You'll keep like, naturally, as you do it over months, you start to actually notice prices and become a bit more. It just happens. Like you become more familiar with the market. It takes some catching up. But and then once you're there, you're like, oh, that's new, and I know this address, and this sold. I was actually paying attention to it last week, and I understand that. So then now take us through the first purchase and where it was, how much it was for, what you needed to put up.
Yeah, definitely. So my purchase was not something that was $600,000-$700,000. Absolutely not. It was what I could afford at the time, and it was to be a stepping stone for future. So I think it's a massive misconception that people have to save up, $100,000 to get a property. You can use property as a stepping stone to then, get exposure to the market and then grow it, like, by using the equity from the first. That was my mindset. So my first purchase was a $134,000 property, and it was a house with land content. It had I think about 500, 600 square meters as the actual land size, and it was in Ballarat. So it was a house. It was near the lake.
Further out,
way further out. It was, and for me, I thought, like, $134,000. I Googled Ballarat and I was looking and I'm like, whoa, you know, there's properties that are like, you know, it just made sense that something just over an hour out, an hour and 15 or whatever it was 134,000. For me, just logically, I was like, it's an hour out. The infrastructure's there. You know, there's going to be government spending. The population growth forecast is increasing. It just made sense that it was going to go up for me. Like I just thought, like even put the data aside, I thought 134K, it has to go up. And this thing was like paying for itself from the get-go. It was like $220 a week in rental coming in versus the, I put down a 10% deposit. So I put down 13,400 and then I had stamp duty and lender's mortgage insurance to pay. So stamp duty being the amount of, it's a government charge, but basically that would have been probably close to $3,500 if I remember correctly. And then we have something called lender's mortgage insurance, which is a fee to the bank for going in at a 10% deposit. But that's okay as well. You know, it's the cost of doing business. So I was happy to do it.
So what was like your total upfront costs?
I'd probably say under $20,000, close to it though. Yeah.
Okay, so just under 20 grand. So then you get exposure, and you're using your pay slips from your job, obviously, to get the to show servicing.
And I was working part time too.
You were working part time.
I was working like 3 days a week or something. So it was, because the cash flow from that property was so good. Like I was probably earning like $700 a week or something. I mean that's very hard to do now, and I probably, you know, it's lucky that
$700 a week.
For my work, I was earning that much.
Yeah,
probably not even. That's probably $500 a week. Actually, so I wasn't earning that much. But the bank still
gave you the loan, and that was a different time as well. 8-9 years ago, I remember I applied for like I was making like $300 a week, submitted a pay slip, and I got like a $10,000 unsecured 19% interest loan, like back when I was making, you know, when I needed access to cash to get my businesses up. But now you can't do that. Like there was a time where they used to give money a little easier. So now you get your first property, you get in. How long does it take before you get your second one?
Yeah, so this property, it was a lot better than I thought even. I wasn't even really buying it for growth. I bought it because I wanted something. I needed it. It would have been probably 18 months, maybe not even. And we got the property revalued, and the property was revalued at like way more than I bought it for. I think it was valued at close to $200,000 or something around that realm. And after that, I was weighing up, well, I'm earning, you know, $500 a week and getting reamed. Like I was actually working 4 days a week in real estate, with a Saturday being one of the days as well. So I remember like I'd probably saved up like $15,000 for the year. And then I looked at my property and I was like, hang on a minute. Like I bought this for 134K. I've got like 120K on the loan. It's worth 200. I'm like, there's $80,000 here. And the whole year I was working, I made 12. And I saved it. And I fucking hate my job. Like, and I was like, hang on a minute. Then it got me thinking like, all right, is there a better way of doing something? And I got it valued. And then I was like, and it pays the mortgage off like on principal and interest. And I was like, I think I'm onto something here. And then, probably within 18 months, I actually bought 2 more on the same street in Ballarat, which was right near the lake. And
you did that by?
And I did that by... would have been a combination of saving up a little bit more money, not much, maybe I had another $15,000 or something, and taking out equity from the first property. So the way it works is, you know, once you get your first property, you can take out up to 80% of that, of what the banks allow as usable equity. So the difference between your debt and 80% of the value of the property is commonly what you're allowed to take out. And I took part of that out. So I guess I stacked a bit of debt on debt. And I put a bit of my own money in, and that allowed me to get 2 more on the same street, and get to 3 pretty quickly. I think I would have been 20 years old, or you know, maybe 21 or something, and I had 3 properties, houses in Ballarat, and I don't even know if I had a car.
So you're operating still pretty lean, right? From that. That's
definitely
cool, man. And I think that's really, that opened my eyes, because we've known each other for years now. And I remember we were having coffee once, and I was like, oh, wait, I get it now. Like the reason why people have so many properties is because if you do it right and you have the right strategy, you can leverage the first. It gets progressively easier and much quicker. You become much quicker at being able to accumulate property because you've got more properties that are simultaneously increasing in equity value that you can use to get more. So then you use your first one to get the 3, and then these 3 are all increasing in equity, and then you could use that to get your 4th and your 5th. And was that pretty much just the journey up until now?
Partly. So I guess there's 2 parts. It's easy for people to save deposits. Like anybody can get, not anybody, it's hard, but the most common problem that people run into is not saving up the deposits to buy the properties. It's actually getting the right kind of properties that will allow them to get to property 4, 5, 6 if they want to go down that route. Because the problem is that the bank is hurting you at each purchase that you're doing. So your cash flow is really important and your balance sheet is really important. Like the bank's only going to take 70% of the rental. The bank is you might be spending $1,300 a month on your expenses. The bank's going to say, too bad, we're calculating you at $2,000 a month. So they're inflating everything. Your interest rate might be 3%. They're going to work it out at 6%. Your cash flow has to be good. And I see a lot of people will just buy 1 or 2 properties and they'll just buy whatever. And that's okay. But if they're wanting to get a long-term strategy, it's tough. And I mean, look, to be fair, I probably got lucky because I bought something cheap and the cash flow was good off the bat. Like it was $120,000 debt. The property went up to 200 really quickly, and it was giving me $220 a week. So if we were to work that out, like $220 a week, like might be, I don't know, 1,100 a month or something. If you do it the way the real estate agents do it, they divide it by 7 and stuff. So even with the banks buffering everything, it didn't look too bad. And then doing that again wasn't too difficult. And then my 4th purchase was actually an apartment in the city that the outgoing was about $1,300 a month, and the actual rental that I got in was close to $2,000 a month. So my focus is obviously growth is very important, but I'm also looking at what does this purchase set me up for the next purchase, You could have a situation where you could buy a property at 8% growth or something, but then if your cash flow isn't good, you can't buy anything else. So you have to be really careful about that too. And
so with cash flow, what do you mean by that? Is it more, I guess, like how liquid you are in terms of cash in your account, or is it are you referring more towards like your earnings? Well, what is it that you're?
It's when I say cash flow, I mean like the property statistics itself. So the cash flow of the property, nothing to do with yourself. Your cash flow has to be good in terms of how much rental you're getting in exchange for your outgoing to the bank. So in exchange for what you're paying to the bank. So your money coming in needs to be bigger than your money coming out from the property if you've got the property by itself.
Yeah.
That was like.
So that's about selecting the right properties that actually put you in that position. Okay.
Yeah.
I understand that.
Because there's a statistic out there. It's like, I think it's 1% of the population half a percent of the population get more than 3 investment properties. It's because the banks don't allow them to keep investing. It's not because people don't have money in the bank. People have got, you hear the term all the time, asset rich and cash flow poor.
Yeah.
There's people who, might have their own home that's worth $2 million, but maybe it's a single woman who's got the property as an example, or she's moving into retirement and she's earning $50,000 working a few days a week. If she wants to actually buy an investment property, she's going to go, I got $2 million in equity. I should be able to buy a property. That the banks don't care about that. It's about what your inflows are. So it's completely separate to your actual asset position.
Yeah.
If that kind of makes sense.
No, I get that. And at Maple, you guys are now even assisting people with getting the loans for the properties that they're investing into. Is that right? From a finance point of view?
Yeah, we have another entity that's connected to our group.
Okay.
Who's owned by us essentially.
So at least you've got experience in that department. So what would it be like? Well, let's do a quick checklist on the most. If someone's listening, being like, "All right, Beau, what do I need to do to put myself in the best position to look the best to with the bank?" What would be like the checklist?
100%. I guess some like quick rules might be if you're going to go and get a loan quite quickly. Some of the red flags might be like your sports bets, your lab brokes, like that sort of stuff, like quite quickly. It's not going to be a no, but it's just going to be like a red flag. Like they're going to ask about it. They're going to be like, how consistent is this? Another one might be like transferring money to your friends and sort of doing it as a joke, like and putting like some sort of like, inappropriate name down. Like
no way.
Like whatever,
Yeah,
like
yeah,
drugs
yeah.
or something,
Yeah,
like
yeah,
whatever.
yeah.
And like doing it, even if it's a joke, that will flag up and they'll ask you questions and they'll genuinely question your conduct and if you should be getting a loan. You want to make sure that you have no defaults as well, like on property, on like, any credit cards or something or things that you don't remember about. Yeah, they're probably some of the big ones.
What about
there's
from like
heaps more.
your salary, like your savings? Because does a bank like sit there and take a look at like how consistently you're able to save?
Yeah, they do. They have something called genuine savings. So a lot of the banks want to make sure that you've saved the minimum 5% of your own money. But that's not across the board. Like for us, we're brokers. Like some banks, they won't even care. And some banks are quite stringent on it. So it's about, I guess, having the options. Some banks, you don't even need to save any money. Like you can go through a situation where you don't actually have to put any money down on the property and you can actually get exposure to the market. As crazy as that sounds, you can kind of borrow somebody else's equity.
Wait, do you mean from a guarantor point of view?
100%.
Yeah. Could you explain that? Because I saw your TikTok recently,
Yeah.
and it was like you don't need an actual deposit because someone else's if you can have a guarantor, their equity in their property can act as your deposit. Could you explain that as well?
Yeah, 100%. I guess to satisfy a loan with the lender, there's two things. There's going to be the cash flow, which we spoke about before, and the security value. So that's being the security being the actual property that that the banks want secured. So if you don't have much of a deposit, but you've got, a trusted friend or more so family member, it's more so a parent to child sort of situation. What you can do is rather than putting a deposit down, you can actually tap into your parents' equity in the property. So your parents' growth and you can basically use part of that to actually invest yourself. And technically you wouldn't have to put any money down. And even if, you have part of a deposit, a lot of people will actually do it to save on a lender's mortgage insurance cost as well, which is can be painful having to pay that as well.
So if there's someone listening and they, their parents own the home that they've lived in, they've been there for say like 10, 15 years, surely there's definitely some equity, especially if they bought it for 10, 15 years ago. There's a lot of equity in that home, and they're looking to get some exposure to the market. They find a really, really good investment property. They can go to their parents and say, hey, I don't have the deposit, but I think this is a really good investment. Can I use you to be my guarantor? And that way I can get, not everyone has the luxury of being able to do that. Yeah. But for those that do, at least it's a way they can get early exposure. So you're saying?
100%.
And there would be no other costs like LMI, or would stamp duty and LMI all be paid by that guarantor on a loan or
Yeah, well, technically there wouldn't be any lender's mortgage insurance in most cases.
But wouldn't that have to be at 20% though?
Well, they're using 20% of the parents' equity and the parents wouldn't necessarily be putting any money in. All that's happening is the securities are being crossed. So for instance, the parents' property that might be worth, call it $800,000 and they've got $200,000 remaining as an example. Say they're, all they're doing is, technically kind of tying the parents' property into the child's purchase. So it's not a situation where you have to actually fork out, they'll have to fork out any money. It would be, there wouldn't be any lender's mortgage insurance payable because the total, it would be done together. So the total loan to value ratio would be under 80%, which means no lender's mortgage insurance. Stamp duty will be payable though.
And that would depend on how expensive the property is. And so we'd say it would have to be like if you're buying a $500,000 property, I'm just trying to actually wrap my head around this. Like you're buying a $500,000 property. So let's say you need $100,000 as a 20% deposit. And then your parents' home has $600,000 in equity in it. How would that work? I'm just trying to get that. Would they tie up $100,000 from their, so would they tie up $100,000 from their $500,000 that, did I say 500 or 600?
I think it's a 5.
Yeah. So would they tie up $100,000 from that 500? So their parents are actually risking $100,000 or how does it work?
Yeah. So, well, their parents are at risk 100%. If things go sour, the loans are combined. So if being the son or,
so is the loan, but the child would be taking a loan on their name or would it be on the parents?
The parents would be taking the loan. but they'll be taking it for the child, and the child would basically pay them back. Or it really depends on how you want to structure it. Like there's a million ways things can be structured.
Okay, yeah.
And every bank's going to be slightly different, but most commonly it will be pretty much.
So it would be case by case. And if anyone wants to kind of discuss this more and further, it's probably better just to actually have a proper sit down with your team, which I get it. We kind of like break this down all in this podcast. But I was actually, because I've been aware that you could do it. I just never really explored it deeply.
Yeah.
So cool. Now that's an awesome little tip there. I'm sure it's going to spark some interest for people to find out more about that. Now, obviously when we were talking about your property investment, we went from 3 to 4 to 17 really quickly. In between that time where you were just accumulating property, did you just stick with your standard residential investments, or you also would diversify it and got other things?
Yeah, I guess early days I was more so residential. I found the growth rates and everything were good. I knew it. I found the process. I knew it was safe. I could manage the risk, and I just rinse and repeated it. So I guess early days I did residential. My next purchase, I sort of messed that up. Like I bought an apartment, and I think the apartment cost me like $350,000 or something, and I think now it's maybe worth like $400,000 or something. But I bought that like 7 years ago, so I bought it when I was like 21. So
do you want to tell?
Yeah.
You want to tell them the mistake you made?
Oh my god, I forgot about that. Yeah.
So do share.
Yeah. So after my third property, I became a little bit confident. I was like, all right, this property thing, like it's easy. There's it's pretty straightforward. I can do no wrong.
Yeah.
I have my 3 Ballarat properties. So I was just arrogant, 21-year-old. I was like, things are good. So what I did is so during my lunch break, I was working as a mortgage broker, and I was also working in recruitment because the income was good, so it was helping me service my loans. And on my lunch break, I remember I went out to have a look at this property, and arrogantly I looked at it. I was like, yeah, I'm cool. Like, how much do you want for it? They're like, yeah, like 370. I was like, I'll give you like 350 right now. And the guy's like, I'll put in the contract. And I was like, yeah, I'll put in the contract. So I like wrote it, and I was like, all right, cool. And the guy's like, how's your finance? Like, you're pretty good for finance? And I'm like, yeah, bro, I'm a mortgage broker. Like,
yeah,
I'm good.
How ironic.
Like when I just started at Aussie Home Loans, I was doing a bit of work there, and I was like, and he's like, all right, cool. So your finance is definitely fine. I'm like, yeah, why does he keep asking me this? Like, yeah, cool. And I like signed it, and I went back to work. And then, every few days, this guy would be like, hey, can you transfer like more money? I was like, all right, calm down. Like, I got the finance clause. Like, what's this guy like rushing me for? And then like I transferred like the whole like 10% or something, because he kept pushing for 10%. I thought it was like 5, but anyway, I transferred it, and then I'm like, yo, like how much longer do we have on? I asked my conveyancer. I said, how long do we have on the subject to finance? Like, do we have much time? Conveyancer's like, what's subject to finance? Like, you signed this and you gave them the money. Like, you didn't put finance. And then I sat back. I was like, it all clicked. I was like, oh shit! Like,
that's why I
put no subject to finance. Why he kept asking me? And
I wish I had my. I've got some sounds here. No, not that one. Yeah,
that's the one. Yeah, man, I couldn't believe it.
Oh no, man! I remember those sounds. I'm like, oh, this is the perfect.
Yeah.
Wow, man. And so you're essentially, I mean, explain how bad that is, like how dangerous that is.
It's horrible. I mean, what I actually did is to get this next purchase, I took out equity from my investment properties. I actually had to put 20% down on the apartment because banks didn't really like apartments, and it was sort of a funny sort of situation at the time. They didn't like where it was and everything. So, so what happened is I actually handed over, would have been, close to $85,000 or something like that just for the deposit part. And that's unconditional. That means that if I can't get the finance, I wouldn't keep that money.
You would lose. So unconditional means you would lose the entire deposit. And what you don't have liability to the actual total amount though. It's just the deposit, right?
Yeah. It was just the deposit. They would have just taken the money, moved on, resold it. But I didn't really look at my finance before it. Like, I didn't speak to a mortgage broker, even though I was one. I sort of just started, so I was studying, and I didn't even think. I just was confident. I was like, yeah, I'll be fine. But and to make matters worse, actually, I applied and I got denied.
Oh.
So I got denied on the first one that I went through. And I was like, whoa. I was like,
I know it's green now. It's a green one.
great.
That's
You have a
incredible.
few more of them later.
Yeah. All right. Wow, man, that would have been like, I can't even imagine you sitting there. Like, that would make me just,
Yeah.
that would have
Like
been insane.
21, maybe 22 or
Yeah.
something. Like it was all the money in the world. I mean, it was all of those good decisions that I made would have just been
Undone like that.
Yeah.
Far out. Okay. So it taught you a really good lesson though, which is great. And then after that,
I did get the finance in the end. So.
Oh yeah. Sorry, I skipped over that.
I didn't
part.
lose it. Yes.
Wait. Where on earth is
Where
it?
is it, man?
Yeah.
Yes.
Yeah. Okay, they're side by side. Now I know. Sorry, guys. I'm learning on the job here. Yeah, he got his finance.
Finally.
All right, cool. So, and then the rest of the properties, just very quickly, what else have you like dabbled in? Has been more just the same residential approach? Because I know you've done other things as well. Like,
yeah, I have a commercial property, industrial property, which is in Hastings, which is sort of not that far from Mount Martha.
Yeah.
It's like 20 minutes on the other side. So I have that, and actually shout out to Panna. He got me that. If you guys know Panna.
Of course. Yeah,
so,
Chris, right?
Yeah. So yeah, he sorted me out, and yeah, that was cool. The other stuff that I've done, actually early days, I think after the apartment, I got 2 car spots. So I have car spots as well. I've got
when you told me that, I just thought it was so. I'm like, okay, Beau's just doing too much right now. He's buying car spots. So you bought an actual car spots.
Yeah, got a few in the city and stuff. Yeah.
And are those expensive?
No, they were like $50,000.
Yeah.
The banks didn't really lend against them, but I thought that if I could take some equity out and put the money towards it, it would solve the problem of cash flow being like, because these things, like you pay $50,000 for them, and like, you're getting like $500-$600 a month for them back. So for people that know finance, like that return on investment, like even though they don't really grow, the actual cash flow from that looks good. And I mean, if you get 2 of them, like that's $1,200 a month. It's a lot of money to put on your spreadsheet. I was obsessed with spreadsheets. Like I look at Robert Kiyosaki, I was like, I want to add more A's to that column.
Yeah.
Like I just wanted to add A's and like the assets, and I was just even like stupid shit. I just wanted to
you just wanted to add more to it.
I just wanted to add more to it, and
but now you're doing that through business. You don't have to do that as much anymore because it's all through, like, now you're able to do it through business. I think
it's B to I.
Yeah,
business to investment is so much more powerful.
That's more of a, if you're on a real kind of fixed salary approach, like you just want to add more cash flow. But I don't think it makes a lot of sense if you've got a business and you can just really turn that up from that point of view.
100%. At the time, I needed to do it because
but you needed to do it.
100%. If I was on $60,000 or something, bank doesn't want to give me more money.
Even if you have the cash, they prefer to see the cash flow. So it's like you just got to tie up your money temporarily in this to get your cash flow up so that you would get more from the bank.
100%.
Yeah, it makes total sense. Yeah.
It's a bank thing. It's otherwise everybody could get to this level. It would be easy, but the banks make it hard. Yeah.
I'm getting the idea is just it's a few things that I've learned from this. So to begin with, it's getting exposure is very, very important. So when you're at the beginning, don't get too caught up on making the perfect decision. Obviously, be very diligent, do your research. And if you're not confident or don't have the time to do it, that's where you can approach someone like yourself and your company that can help them do all that research. You guys do it. You're very experienced. And what I love about you is that you also buy properties in the areas that you're advising, which is awesome. Now, second thing is pay very close attention to the idea of cash flow. So, making sure that when you're buying properties, this isn't just about buying a property. You got to think long term. Is this going to be a property that is going to look good from when the banks look at it, so that they continue to service, continues to have obviously growth, but also the bank will take a look at it and be confident to continue to give you loans and for you to service. And then once you've got the first couple, it becomes so much easier to get the rest. Like it took you 18 months to get to your second and third, and then your fourth, and maybe you probably would have been you would have got your 17 much quicker if you didn't make that mistake.
Yeah.
And then the last big lesson is make sure you read your contracts and never sign always sign subject to finance.
100%. At least speak to a broker and know that very careful. You can absolutely afford it. But
yeah. I want to show you something. I shouted you out on a recent podcast I did. Shout out to the boys at MK Enterprises. This is a recent podcast. So we were actually talking about cars, right? Because I love my car and it's like it's my baby. And I was talking to them about like how I got my car, and yes, it is good for, I guess, social status from how people think, but really it's no indication of wealth whatsoever. And actually I brought you up, and this is going to segue us into this next conversation, cool. But I'll show you, because you haven't seen this, have you?
No, I haven't seen it, man.
All right.
Some people sort of just make that sort of association.
I feel like it is, though. I feel like that's the issue.
That's like, the biggest lie
it is.
That a person's car is any indication.
I know.
One of Beau, if you go, feel free to look this guy up. His name is Beau Arfi. He's a friend of mine. He owns 17 properties. The guy's like 26 or 27, I'm not sure, or 28, I don't know. Sorry, Beau, for not knowing that. He had a Merc. He sold his car to buy a property. He doesn't even have a car.
You know, like,
this guy has 17 properties, doesn't have a car. Whereas, and he's like way like, I mean, on property wise, is killing it compared to me. Like, he's on another level. And I've seen guys.
So that's my little shout out for you, looking out for the boys. Which segues is like, it's a good segue into the next conversation. Is just the fact that, bro, you were riding around a bicycle and you had like, I don't know how many properties, and then and that's just the perfect indication. If someone sees me drive my car, they might be like, oh man, this guy must be doing really well. But then they see you right next to me driving your bike, and they're like, oh, poor guy. He's looking at the guy in the M4 being like,
the rain and shit.
He's looking, but you're the one who's actually in I mean, especially property wise, like, way crazier position. So what's always been your mentality, materialistic wise? Is it just been something you have to force yourself not to buy, or you're just not that kind of guy? Like, what's your idea? And tell us about like the thought process of selling the Merc to buy a property.
Yeah, I mean, for me, like, I just it's a tough one. I feel like when I got the Merc, it was like, it felt amazing and like I loved it. But at the time, like I feel like I didn't have shit figured out at all. Like I felt amazing driving it, and I was like, I felt good. But at the end of the day, like at the time I bought it, like I didn't have a business. I didn't have that much going on. Like I had the properties, absolutely. But my actual income position, there was a time when, where I was about 24 or something, despite having, an awesome asset base that I built up over time, I felt like that, my inflows weren't that good, business hadn't started up properly, and I was having to work a little bit to kind of, the properties were all self-funding, but to actually make the repayments on the Mercedes, I was like working, and I fucking hated this job, man, like really bad. And I just thought like, fuck, like I'm literally working to pay this thing. And I guess now my mindset is, I guess like there's still like, don't get me wrong, like I'll be on car sales, and I'll be like, fuck, like, Ferrari looks pretty cool.
Yeah,
you get like a California for like 240, and looks nice. But and absolutely I'll do it. But for me, it's just been like delayed gratification. I think that I would rather, really, for me, it's all long term. It's all delayed gratification. I don't want to be the coolest or look the best at 26 or 27 or even 30. I want to know that I can do it, and I guess it's the more so that I know I can do it. Like I know I could go out and and buy a brand new Mercedes, and it like wouldn't even cost me like a month's salary, really, like not even. It wouldn't matter. Like it is the fact where every time I could do something like that, I buy something that I buy a property, but in my little way, it's lashing out. I mean, for me, that property that I've bought on St Kilda Road, like it's 200 square meters. It overlooks Albert Park. Like it looks amazing. Like the view's incredible. Like that's a lash out for me.
Yeah.
And I also think like long term, like I'm like these people that have like real money and like can buy like like people that can compete on commercial real estate blocks of land. You know, they need like $10 million to compete with people. Like they need deep pockets to do this sort of stuff. So, I mean, I didn't come from money. So I think for me, in my mind, I'm almost doing myself a disservice to look cool if I was to slow down my process. I mean, I want to be able to compete with, you know, major developers in the future to buy pieces of land. I want to, you know, be a name, you know, not at, you know, I want to be a well-renowned name at 40, and I don't want to look the coolest at 27. You know, knowing that I can do it is
enough for you.
It's sort of enough for me, yeah. And I lash out in my own ways. You know, those properties, like I didn't need to buy my own home. Probably a little bit dumb, but I was happy to have it. I didn't need to spend $1 million on an office that I've bought, but I just, you know, I did it, and I think that. Yeah, for me, it's just a long-term thing.
Yeah.
And I feel like I'm nowhere near in a position where, you know, rich people, like people that have really deep pockets, like that 0.1%, like they roll their money over. They've got like millions of dollars, and that just rolls over. Like I need to be like, you know, for me, I feel like I need to be like at a much higher level to justify it. And this is not like take my word on it. Like, you know, I might just go like, fuck it next year and get something pretty cool. You know, I may, and things change, but that's been my mentality to date. Just real long term. I mean, sometimes I felt a little bit funny. Like I saw some of the boys on the Friday or something. I was like, fuck, like everybody's got like a $200,000 car. And I just pulled off my MG. I'm like, I felt a little bit like, but not much. Like I felt okay because I knew I could afford it if like I wanted to. And
But
it's cool
in terms of asset position, like you're number one. So you know, like that to me is it's real cool. Like there's no doubt when I bought my car, it did something to me and my business, which was of a good ROI. There's no doubt about it, right? Especially when you got a social profile, 100%. But the real ROI for me, and that's why I wouldn't even. It doesn't matter to me. The cost of my car is 100% worth it. It's because of how it makes me feel, you know. But if it doesn't bring you that, if it doesn't do that to you, then it's not really that worth it.
It stopped doing it for me. The return on happiness was like,
there you go.
Right,
my
you know?
return on happiness is at 100x ROI.
Yeah.
I get into my car every day, and it just makes me. I could have the worst start to my morning. I'm in a good mood when I get in. I could have the worst end to my day. I'm in a good mood when I jump back in the car and I drive home. Like, I think there is something called, we'll coin it, ROH, return on happiness. So I don't think I've ever heard that before, but it's definitely real. So it's got some good ROH, and just make sure you're not doing it to please people that you don't like as well. I think that's a big thing. Like I definitely didn't get my car at a time where I cared about pleasing people. I did it just because of how it made me feel. Cool, man. Now let's kind of move more onto, I guess, current day conversations. This would be just something I'm curious to talk to you about. So, you know, we talk quite regularly, and we're talking about, you know, just investment in general, and something that I have definitely learned over the last like 12 to 18 months is the importance of allowing your money to work for you. And it's so funny because, you know, when you hear expressions like money makes money, you need money to make money growing up, I get it now in a way where when I got to a point where I established some sort of a cash position, and then I put that money to work, it started working for me, you know, just like in The Richest Man in Babylon, it's like your money works for you. And for me, it was, you know, one way it worked was in the crypto world. So, you know, I got in at Bitcoin
100%.
back in November last year when it was at 19 grand, rode that all the way up to like, you know, and I put a decent amount down, rode it up to like 50 grand and then sold it and made literally like a 10x return on my initial investment. And I haven't even I don't mention crypto on my stories because when I'm doing crypto investments, I don't always know what I was investing into. But now I've been, over the last few weeks, been doing serious homework into like the NFT world and the metaverse. Like it sparked something in me that's gotten me so excited, and I don't know much, but I know that I want to be every bit involved into this new and emerging world. So
question I have for you is, as you're investing into property, and I know people invest into property are very much like, no, invest into property. It's tangible. It's physical. There's some sort of value. But you've always been a bit more open-minded, and you've always had the mentality of exposure. So can you talk to me a little bit about that? Because that actually helped me as well. Idea of exposure.
Yep. Yeah, 100%. I guess, and to go on your last point as well, where it takes money to make money. It certainly does. I mean, if I was to tie up money into in a property, or maybe like, if I was to get a car or something, if I keep that money on hand and try and roll it over, like, for me, I've got absolutely, as you said, like it's not a one thing. You have to stay open. There's trends. You have to be adaptive to change, and you have to. I mean, like for me, like TikTok as an example. Like I started myself.
I've been telling you to do TikTok for so long. Finally, you did it. I'm telling you, man. 12 months from now, if you keep pushing TikTok, we're gonna have this podcast interview again, and your business is gonna be on another level. Especially because you're in the property space. I just know you're gonna get millions of views on some videos, guaranteed. Yeah. I'm glad you finally did it.
Yeah, so we're getting on it, but you just have to be adaptive, and my big ones have been like I love property. It's done very well for me, but I'm not closed-minded to say that property is the only way. I think that you have to be open to things. I love crypto. I mean, I've been in crypto for probably over 12 months, maybe longer. I don't know, no, probably close to 2 years.
I was in crypto in 2017 as well. Okay. Like I rode that wave, but then I got crushed.
Yeah.
Like I got wrecked.
Yeah, I think it was like 2019 or something.
Yeah, 2017 I was in very early, and then when I got destroyed, I didn't even want to look at it, and then I re-entered like last year, just before the big run up. Yeah. But when you're investing into crypto, are you just sticking to the big ones, or like your Bitcoin and Ethereum?
Yeah, for me, like I probably have a similar mindset where, I mean, originally I was accumulating Ethereum. So I have a bit of Ethereum that I've been building up, that sort of sits in an account that generates interest. I think I get like 6% off that Ethereum.
Oh, you're staking it. Is that what it's called? Or
I think so. I get like 5%, but I don't think it's at risk or anything. Like it's just chilling there, and it's been.
You've essentially locked up your Ethereum, and then it's I think it's called staking from.
It's actually it's not locked in though for some reason. Like it's off this platform called BlockFi. I know I can just take it out whenever because I've done it before. But I think like I know of staking, like on the Binance app and things like that. Yeah. But I think it's similar, but I don't think it's locked in. Ethereum, like I've been pretty big on Ethereum, like early days. Like I bought a fair bit at 1900 Aussie, 2200 Australian. Like I was kind of picking it up there whenever that was. I managed to get it around there as well. Yeah, nice. Especially during the crash. Like there was like a 40-50% crash in like a few months ago, and I was like, I'm at a point now where when crypto crashes, like that fear of like, oh, it's going to go to zero is like gone. Like I know there are some like projects that are 100%, always going to bounce back up. 100%.
So you just got to accumulate on those downturns.
100%. But I'm in two minds. I'm like, I got that hold. So I got like my Ethereum, I got a little bit of Bitcoin, and I have like Link. And then like on the flip side, like I have like a bit of money that I'm just trading at the moment, where like I'm noticing like that the long-term hold is amazing, and I will keep a position there. But also there's a situation where sometimes it goes up 15% then back down to 10%. I'm like, I'm not worried. Like this is, as you said, like this is stable. This is good. Like this is not going to zero. I'm happy to ride the wave a little bit if it decreases, and I'm not going to sell it. That's the position that I'm in for the other account. So I'm sort of in it two ways, and I'm researching heavily into NFTs. I think it's such an exciting space. I don't think people till now realize just how massive NFTs are. And because it like the conversation is still very much NFTs are digital art. And it kind of just reminds me of the type of conversations that were had when Bitcoin was like at $100 or $10, and it was more like, oh, this isn't tangible, it's not going to go up, there is no real store of value. It's like, oh, this is just a digital art, I can screenshot it, I can copy paste it. It's the exact same line of logic and conversation. 100%.
And if that does anything, it actually increases my confidence that it's going to work. But see, for me, NFTs didn't truly really sparked my interest until Metaverse came to the spotlight. Like when Facebook changed their name to Meta, and you know, the video with Zuckerberg. Yeah, even though like a lot of the community, if you understand the idea of the metaverse, and it's the whole point of it is to try and be as decentralized as possible, whereas Facebook coming in and trying to really create their own meta world where the whole idea is for it to be for the community and decentralized. But the fact that they've stepped in, it means it's 100% happening. They're putting like $10 billion to invest into it, I think, every year. Or just for the next 12 months. You can fact check me on that as well. Apologies if I'm wrong. But I know it's 10 billion over a certain period of time. So we're eventually moving to that world. And then as soon as that got confirmed in my mind, I'm like, NFTs are 100% going to be tied into that perfectly. And so they're not going to go anywhere. And those meta worlds, the metaverse that we're going to be somewhat partially living in, even like as an employer, it's exciting, man. Like imagine putting on your headset, instead of jumping onto Zoom, you put on your headset and suddenly you feel like you're in a boardroom table with your team. And you can just put up videos just by pressing buttons, and you can go through the presentation, and everyone's dressed in their avatar, and it's a better step than Zoom.
100%
to me. Like someone was said to me, "Wait, explain the metaverse to me," especially when I was talking to them about crypto gaming and why it's such a big deal, and I said to them, "Put it this way, metaverse, like playing games, like playing Fortnite." What the metaverse does is right now we play Fortnite on a screen. When the metaverse gets introduced, we're going to be playing Fortnite inside the screen. We are going to be that character, and we're going to feel, like we're there, right? And I genuinely believe, like in years to come, like you could say 50 years from now, 100 years from now, whatever, a generation's going to look back and go, I can't believe you guys used to play games on watching a screen. Like we play games in the game. Like I am that main character, and I feel that main character's what they're feeling. If I get shot, like there's an actual pressure being applied, and if I get surprised, my brain actually feels like I've been scared, and it just brings so much reality to and it's exciting. Like naturally, there's some negatives to it, because people are going to be living in that world, and how can you start to distinguish reality from but that's a whole nother conversation. Like what tells you that's not real? That's just as real,
that's right.
So so based on what you've looked at so far in the NFT, what's like your mentality up until this point?
I guess for a long time, like really probably similar to you, when Facebook officially changed it to Meta and started releasing these videos, it was really intriguing, and it probably gave me so much more confidence that was the direction we were heading. Probably 4 or 5 months ago when I was first noticing these coming, I was like, I was trying to get my head around it, because I didn't want to be somebody that was like, oh nah, it's doesn't make sense, it's ridiculous. So I was just like researching it and trying to understand it, and I wouldn't say skeptical, but I was just like I'm just trying to get the concept, and then and I guess over a few months I'm just kind of putting pieces together, and it seems like it's the inevitable direction of the future. The more research that goes ahead, I'm just like, this is where we're going to be. We're going to be engulfed in that, in that character or player, or we're going to go into a boardroom and be like, oh, hey, can you show me this? And you're going to be that person, and you could be on the other side of the world, but it's going to be that step after Zoom. It's and it's going to be completely picked up mainstream. And I like to work out what the negatives are as well, but you have to change with the times, and it's easy to get scared and be like, whoa, like what's in store for us, and there's going to be Face ID and everything everywhere, and it can be scary, but you can't just be in fear, I suppose.
And I feel that for a long time, through generations, there's like different categories of people. There's people who literally pioneer the next phase of our life. So those are the people who actually created the NFT, the blockchains, and everything. Then there's the early adapters. Those are the people that identified it, actually paid attention to it, and get in super early and create monstrous businesses as a result of being one of the early people. Like OpenSea, for example, where the NFT platform where you can actually buy and sell NFTs, they are killing it right now. But you know, they were working on their platform and no one was paying attention to NFTs. So they're one of those early adopters now. I don't know, OpenSea, MetaMask, these are worth billions and billions of dollars now as platforms. And then you've got the early adapters. Then you've got, you've got people who are maybe like us, who weren't the early nerdy adapters who noticed it in 2017 when it first came out, but eventually do catch on and then try to play some sort of part. And we also have an opportunity to participate in a big way. But then you've got participants, and the participants are people who don't really realize what's happening, but they just participate in the change of events. Like when Facebook was introduced, that changed the fabric of how we socialize. And there was people in Silicon Valley developing more and more social platforms, and there was businesses being started, and people became influencers, and there was those early adopters. But for the average person, they were just a participant. They just downloaded a Facebook profile, created and connected with friends.
Yeah.
And I just said to myself, I do not want to be a participant in this day and age. I want to be one of the early adopters. I want to be there early on. And my mentality is that in our generations, our ancestors or the people who came before us, their opportunity to build generational wealth, started with, say, oil at some point, right? There was oil, and then there was like the gold rush, and then it was property. Like, you can build generational wealth now, but imagine the grandpas that were just snatching up 10 and 20 grand properties that are worth like $1 million now. They've literally built generational wealth. That was an opportunity, and they were taking advantage of things when people weren't going. They were buying up when people were saying, "Oh, this is too expensive," right? Yeah. And then you have the age of the internet that created an enormous amount of millionaires and massive businesses, and then e-commerce came. And now, without a doubt, the next phase of this big opportunity of a gold rush for people to build generational wealth is 100% the world of the NFT and NFTs and the metaverse and crypto and the blockchain and those technologies. So I'm like, okay, strapped in. I'm ready to give this some serious attention, and
100%.
let's see where the journey takes us. So
Definitely.
I even snatch up like a bunch of domains too.
Nice.
I'm just having fun with it. I was speaking to Christian Graves, and he's like, man, just have fun with it, man. Like, just be happy to hear. I'm like, you know what? He's like, be happy to be here. And I'm like, yeah, I'm just going to snatch up some domains. And I started, and then no one's buying all these NFT related domains, especially .com.au. And I just like snatched up like 30 to 40 of them. So we'll see what that leads to as well. But
my brother's like huge in that.
Yeah?
He loves it. Yeah. He's done like heaps.
Yeah, I love that, man. So anyways, we'll wrap it up there. Man, thank you so much for coming on. Guys, if you want to follow Beau, head on to his Instagram at Beau Arfi, ARFI. If you want to hit up his company, it's Maple Property Group. Mate, what was the actual domain? I should know this.
Maplegroup.com.au.
Maplegroup.com.au, or you can check them out on TikTok or on Instagram. And I'll see you in the next episode. Take care.